Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of welcoming Ken Holman with Overland Group. Welcome to the show, Ken. I greatly appreciate it, and it is an honor to host you today.
Oh, you're welcome. Great to get acquainted with you and excited for the opportunity.
It is an honor, Ken. For folks who, a little bit of the background with Ken. Ken has had a distinguished, illustrious career. He obtained his real estate agent's license way back in 1972, and then he was a broker by 1975. Over the years, he has brokered, developed, constructed, and owned well over $500 million worth of assets, which have included apartments, condos, industrial properties, self-storage units. They have been into office buildings, golf course, medical, hotels, fast food restaurants, and other types of commercial properties as well. Presently, Mr. Holman is the manager of several limited liability companies and also an investment partner and advisor to several investors and numerous other real estate ventures. And I'm sure this bio is far, far shorter than the number of things, Ken, you have done. As I said at the top of the show, it is an absolute pleasure and a delight to, listen to your experience, your advice, and it is a sheer honor. So thank you for taking time today.
Oh, you're welcome.
So Ken, in your words, maybe give us a brief background as to maybe perhaps how you got started and the number of, directions that you have taken your company in is surely, jaw-dropping for sure. Take it away, please.
Well, I don't, my beginnings were probably similar to several others, but when I was attending Brigham Young University and getting a degree in accounting, I had an uncle in the business that said you ought to come and get your real estate license. So while I was in college, I got my real estate license and was able to pay for part of my college selling real estate right from the very beginning. And then I just moved from a degree in accounting to an MBA at the University of Utah. So I'm not a Utah native, but almost claim to be that because I've lived here 45 years now. So
sure. Mm-hmm.
But and then I'm originally from Idaho, and I went to law school up at the University of Idaho. Mm-hmm. Great experience. So, but found that my career in real estate has been a really rewarding and fun experience for me. So I understand that I got my real estate broker's license the year you were born. That makes me feel a little old, Sakar.
No, I mean the experience and the number of things that you have done, Ken, it's an honor to interview you and kind of delve into your experience for sure.
Yeah.
So Ken, maybe get us started about early parts of your career as to perhaps how you kind of came to the construction side of things, perhaps, or I don't know if you did obviously through real estate sales and things. What was that your early career like?
Yeah, so after I graduated with all these degrees and things that I obtained, then I went to work for a financial planning firm back in the 70s. And back in those days, pre-1986 Tax Reform Act, mm-hmm. We were in a position where we were able to work with a lot of wealthy individuals and real estate was a big part of their portfolio because it saved them a lot of money on taxes. And so I had opportunity to begin almost the beginning of my career with a syndication company, and working with investors and things like that. And they put me over the management of all of their portfolio. And so I had opportunity to manage 5,000 units in 5 different states. So that gave me a really good background in terms of understanding the business, especially the apartment business back then. And some commercial, but mainly apartments.
I see.
So that's how I got started. And then I decided after I'd worked for them for 5 years that I decided I wanted to try it on my own. So I resigned from the company, went out and bought a new suit, leased some space in an office building, and thought, okay, now what do I do? And so that was kind of a humble beginning, but I was really excited to have that opportunity. And they had put me over the acquisition side of the company in terms of evaluating projects and analyzing them. So I felt like I had a pretty good background at that. And I created this company called Overland.
Sure.
Originally, it was a management and a real estate brokerage company, and we began there. And then over the course of a lifetime, a career, we added pieces to that puzzle. And so we created a development company. We split the management, the brokerage side of the business. And then I thought, we were doing so well at development, I thought, hey, let's get into construction.
Sure.
Because I come from a construction background growing up. And that was the piece of the puzzle that was the most difficult to put together.
Sure.
Construction is its own kind of entity, and
lots of moving parts for sure.
A ton of moving parts. And originally, we thought we were going to be just like the typical construction company, where we would self-perform some parts of the work. And I learned after a while that I was not that happy running a lot of construction crews and doing a lot of initial competitive bidding on different projects, because there's a lot of risk on the construction side and you have to be careful there.
Sure.
And so we decided to focus on becoming a construction management company. And so we do all the top-down construction stuff like project management. We're the general contractor. We do project management, project engineering, project estimating, and we go to the superintendent level and hire our own superintendents. And then we competitively bid out the rest of the project, which enables us to be able to move into almost any state to do business. So that's the model that we set. And my son Dave got a degree in construction management, and he's run our construction company for about 20 years. And we've got a good formula now that we really like the way we do things. So
awesome. So Ken, help us understand like the challenges within the construction you had, and what was it like that, okay, you wanted to kind of say that, oh, I really don't want to get into the nitty-gritty of construction. I want to, stay like one level up, just do the general contractor, the GC part, maybe the superintendent, or perhaps, play that role of, engineering and developing initially and just manage the construction of sorts.
So, in construction and development, just talking about those two trades in particular.
Sure.
the development represents the owner.
Sure. Mm-hmm.
The owner has a set of criteria that's important to him. He wants to build a project at a certain price,
Mm-hmm.
and make sure that he doesn't have any cost overruns.
Sure. Mm-hmm.
General contractor, on the other hand, wants to competitively bid the project and get it at the best price he can. But if there are cost overruns, he doesn't mind that, because that helps,
Their fees.
his profit,
Sure.
his
Absolutely.
bottom line.
Mm-hmm.
And so we found, by marrying the construction and the development side, it's accomplished several different things for us. First of all, there are certain things in development that are really more attuned to the construction side.
Mm-hmm.
Like when you get into cost estimating on a new project. Well,
Mm-hmm.
if you're a developer, you probably don't have a lot of background on cost estimating.
Sure.
And
Mm-hmm.
so by having a construction company that is actively engaged in the market, we, and with our own estimating department, we're able to come up with our pricing a lot, that's a lot more exact
Sure.
than a typical developer who's basing everything on a price per square foot type
Sure. Sure.
deal. So, and then the other side of that coin is to make sure that your project stays in budget. There's a ton of value engineering that goes into that process.
Sure.
And I'm guessing that most of the people that you're affiliated with or involved with understand the concept of value engineering. But
Absolutely. I take it as if, like, you're playing with different materials or perhaps layouts, and seeing
exactly.
if there are any differences
Yeah.
in delta you can achieve. But go ahead, clarify that.
Exactly. That's exactly what it is. It's looking at the whole scope of the construction project
Sure.
and saying, what can we do to improve or reduce the cost of the project without impairing the quality of the project.
Sure.
And so there's a balancing act there between those two. And by having a construction and a development company, it gives us the opportunity to value engineer. And if we find that in one aspect of the construction project, we're having some cost overruns, like we were building a self-storage project. Our steel went over basically because, of the China trade situation that we've got. Steel
Sure.
went up almost 20%. When that went up 20%, well, how do you keep your costs in line?
Sure.
And we were able, as a construction company, to go out and become a distributor with a steel manufacturer. And so we were able to cut out the middleman in that process, save the 20%, keep the project in line. And we find that there always give and take in the construction and development process, where you can save money here, it costs you a little bit more, but you wind up getting a better quality project, I believe. And you're able to control your costs better if you've got those two entities aligned with each other. I don't know that you have to own them both,
Sure.
but you really should team up with a general contractor that is willing to work with you on that without charging a lot of extra fees and things on change orders and stuff. So
Sure. And change order, as we all know, is pretty much the bad word in construction. That's the one word that nobody wants to hear.
yeah, we were going to Lake Powell, just having a good experience. We rented a houseboat and spent a few days there, and I'm seeing this guy pull up this really nice, almost yacht size boat that he had, and on the back of the boat he had named it change orders.
We know where that came from then. That's a nice one. So Ken, the initial projects, were they more, the typical commercial strip shopping center type projects,
Yes.
or were they self-storages or multifamily? How was
Yes.
that?
How is the business these days?
No. The initial projects that you were involved in, they were more the strip shopping center retail type of projects. Is that what the nature of those projects was?
Yeah. So right now we have under construction and development. We have a 116 unit apartment project
Mm-hmm.
in St. George. We have a 240 unit apartment project that gets its final approval tonight from the city council in
Nice.
Mesa, Arizona.
Mm-hmm.
So we're excited about that. But along with that, we have some retail shopping there. And then we've got a couple self-storage projects. But we do have some value add retail strip centers that we're doing right now, which we're kind of excited about. We found a piece of property that Dollar Tree used to occupy, and they're moving out. So we were able to buy that property, add a little bit of property with it, and convert it to a multi-tenant building, and increase the value of that by almost $500,000 by just repositioning a small $1.2 million property. So it's now valued around $1 million, almost $1.8 million. So
Sure. So now, Ken, talking about different type of properties, and I see that you have a preference or a penchant for doing like the new construction projects, right?
Yes, we do.
Can you maybe give us some tidbits about why you prefer that, and why not just kind of go with the typical value add multifamily projects, or people are doing value add self-storage projects as well? Can you maybe give us a sense of how that plays through your company?
Absolutely. So we've seen over the years a lot of new competitors move into the multifamily space, and there is because they're not involved in development, they're not involved in construction necessarily. They are really combing through virtually every apartment building out there, and you'll find a lot of them that are 20 years old or in that range that have been developed, and those are what most syndicators like to acquire and then do some value add by fixing them up a little bit, making them look a little bit better, and then hopefully increasing the rents to improve the value of the property.
Sure.
Or to support the value that they have acquired the property at. But I have found, and we've done some of that, but I find that those older properties sometimes are a little outdated. You wind up, we were talking a little bit about functional obsolescence.
Sure.
And functional obsolescence basically is most, like the home that you're living in probably has 9 or 10 foot high ceilings.
Sure.
Well, the older projects have 7.5 or 8 foot high ceilings.
Sure. Big difference.
Big difference in the feel, the quality, just the whole modernization concept of how the project is perceived. And so you can get good deals on buying and acquiring existing properties, but I found if you can get a brand new piece of property that you can get rezoned for apartments and then do the development on it, you've created this huge value add to the deal, because the value of the land goes up, the value of the entire project, once you get it built and stabilized, goes up. to give you an example of that, we just put under contract a 22-acre parcel of land on the corner of McDowell and Avondale Boulevard in Avondale, Arizona, which is West Arizona. But that whole area is really expanding dramatically and growing. Avondale, Goodyear, Surprise, Buckeye, that whole area is kind of like the new wave of where everything is going in the Arizona market. There are some other areas over in East Mesa where we're located that we really love the growth pattern going on there too. But this piece of property that we put under contract, I was able to get it at $9 a foot. Everything else in the area is going from $12 to $20 a foot. So we'll go through the rezone process, and our value in the land will go from $9 to $12 a foot. That's huge.
Sure.
Then once we build the project, it'll add, we may build this 250 unit apartment project for $50 million all total. And once we get it stabilized, it'll be worth $55 million.
Sure.
So we've added $5 million of value just by going through the development and construction project. So the same kind of concept when you're acquiring and trying to do value add, just on a kind of a grander scale. And the difference is you kind of design out any economic obsolescence. So everything is new.
Sure, sure. Now, Ken, in that regard, what about the time factor? Like let's say from zoning to development to actual construction, what sort of how many years are we speaking about? And again, it changes by market. I definitely get it. But typically, what is your horizon look like?
If you want to go that route, you better plan on at least a 2-year process to get you from the beginning of the entitlement phase through the construction and rent up. So you're looking at a couple-year process. And what we do with our investors in our syndications is from day one when they come in, we give them a preferential return on their investment.
Sure.
With the understanding that they're probably not going to be paid for a few years until the project is cash flowing.
Sure.
But then within that 5-year window, which is a pretty typical holding pattern, we're usually in a position where they've recouped all of the preferential returns that they had to sit and wait for over the first couple of years, just to get to the point where we got the project stabilized. So
Sure. So I imagine these are seasoned investors who know how the development and construction play occurs, and they're okay with all the prefs being deferred and being paid out after maybe 2-3 years when, as you said, the project cash flows.
Yep, exactly.
Now, when you acquired this land, Ken, what was some of the due diligence that you went through? I mean, taking a bet on this big of a zone of land requires a bit of feasibility study and kind of some due diligence about, can we rezone this? What is the best use for this plot of land? Can you maybe share with the listeners, what does that sort of feasibility and due diligence looks like?
Yeah, absolutely. Just to give you an idea of what I did over the past several months is I have spent a lot of time in that market. And those cities that I mentioned that are in West Phoenix, I literally drove every street, identified every piece of land that was there, called every landowner that I could get and every broker that had a property that was listed for sale. To try and determine exactly what was in the market. I found in that area 55 different parcels of land.
Okay.
So I actually took every one of those, looked at all of them, and identified the one parcel that I thought was the best located at the best price for us. And was able to get a corner parcel of land in Avondale that's just a quarter of a mile off of the freeway, and that Interstate 10 that runs east and west along there has about 220,000 cars a day going past it.
Wow.
And then the two cross streets each had about 25,000 cars a day going by. And so I felt like I was getting a dominant location. There were some issues that I have to deal with, like there's some power lines that I'm going to have have moved. But in talking to the city, and the power company, it looked like that was a possibility to get done. And so you have to take the good and the bad, but location, like anything else, is just absolutely critical if you're going to get the right project.
Sure. Now, talking about some of the, sort of the pricing around all of this, Ken, when
Yes.
you're doing a feasibility study of, let's say the land purchase and some of the development and more importantly, the construction as well, can you maybe at a high level can give us some idea about what sort of price points are we talking about? Maybe it is, let's say for construction, whether if it's per foot or, going horizontal as far as infrastructure. How do you kind of, at a high level, how you sort of budget all these things?
Yeah. So once you come up with a concept design that you want, then that's when you start the pricing. And it depends on what level of quality that you're going for.
Sure.
We're going for a relatively high level of quality. And so I usually price the development cost for apartments at about $200,000 a door. You can get down into the 100 to 125, maybe even 150,000 a door. But it depends on what level of quality you want to hit.
Sure.
And we're going for that a little higher end market to differentiate us from some of the other projects that are there. So that's kind of a rule of thumb that I go by. I'd be somewhere between 175 and 200,000 a door.
Sure.
And
that's all in, I assume?
That's all in. Land, everything. And so, so that's kind of, and at that, we'd be looking at rents in the neighborhood of, on a 1,200 square foot unit of about somewhere around 1,500 a month.
Sure.
That's kind of the range that we look for there.
Sure. And I imagine, Ken, that at that price point that you're saying, this will probably be the Class A type of construction?
Yes, it would be. Yep, exactly. That's A minus right in there. I mean, you don't want to over design the project and then not be able to get the kind of return that you want. But if you're going for a little higher quality, it seems like they're less susceptible to some of the ups and downs that go on in the market. If you're in some of those lower areas, sometimes those people get laid off. They wind up not having enough money to pay rent, or COVID-19 hits, then you lose some occupancy that you're dealing with. So, and they're a little bit more price sensitive. If you raise your prices up, I've seen projects where if I'm in a really price sensitive market, if I raise my rents $10, I lose tenants. And so you want to be careful what you're doing there. But
Sure. Now, Ken, when you started this process of acquiring the land, looking at, some of the possible parcels and things like that, can you maybe describe what sort of things you are doing? Like, is it, doing a lot of like background research on who the owners are, finding their numbers, the broker relations, and more importantly, how do you assess that this land would be prime for the multifamily development? Because it sounds like if it is, like quarter of a mile or half a mile from freeway, that would
Yes.
probably be more appealing for industrial warehouse type of
Yes.
use. But can you maybe describe how do you look at these zoning issues as well?
Yes. Well, this piece of property that we acquired still has an agricultural zone, but it's master planned for multifamily and
I see.
commercial.
I see.
So we know that the city already is planning on it moving in that direction.
I see. So
And
you went
so-
off of the city's master plan. So that's kind of
Yes.
your,
Yeah,
sort of the
exactly.
guiding rod right there.
Yeah, and another principle that we always adhere to when we're doing these syndications is once we've got our concept basically generally identified of what we think might work in an area, then we reach out on a national basis to companies that do feasibility studies
Sure.
that have a lot of expertise in evaluating markets and evaluating properties. And we always get third-party feasibility studies on everything we do, whether it's a self-storage project, an apartment project, a retail project, because we want to know that the demand exceeds the supply.
Sure.
And that's a critical aspect of being able to get in the right markets.
Sure. Now, knowing Arizona, Ken, that we definitely know it's a growing, city and growing submarkets in there. Can you maybe describe that? Was that kind of one of the, driving forces that, yes, we want to be in that market, or are there any other factors that play into this?
Yeah, absolutely. We're always looking for being involved in growth markets. And there are pockets all over the United States that are growing, and then others that are diminishing. There's a certain neighborhood cycle that goes into every neighborhood.
Sure.
And so you want to be in those growth areas for several reasons. One, that means that you're going to have the demand to fill the product that you just created. So
Sure.
yeah, we look extensively at which markets we want to go in, and in this case, especially we're as part of this overall development, we're probably going to do some storage that's adjacent to the apartments.
Interesting.
And we reached out to a company in California and paid them to do what's called a reverse feasibility study. I don't know if you've ever heard of that.
No, I haven't. If you can enlighten us, that'd be great.
Well, usually a feasibility study is you acquire a piece of property, you decide what you want to build, then you go to a firm that does these studies, these demand studies, market studies, and ask them to do a market study validating what you've just done.
Sure.
Well, a reverse feasibility study is you pay somebody to come in and tell you the markets that you should be in. And so we paid a company $10,000 to tell us which markets we should be looking at. And of the 5 markets that they identified for us, this Goodyear Avondale market was one that they said you ought to seriously look at because demand there exceeds the supply.
Incredible.
So that's part of why we went in there.
I see. And you have maybe perhaps a 2-year, 3-year runway before, so you're kind of ahead of that cycle. Would you say that?
Yes. Yeah, that's what it's going to take to get to that point. So
Sure. Now, speaking of, I'm sure the opportunity zones and all these factors come into play when you're looking at all of this. Can you maybe share your thoughts on, if you're targeting your projects to be in opportunity zones, or what are your thoughts about them?
Yeah. So when they come out in 2018, we all were excited about opportunity zones and creating our own opportunity funds and opportunity zone funds. And so we looked pretty extensively at that.
Mm-hmm.
And a lot of the opportunity zones are clearly in distressed neighborhoods.
Sure.
I mean, that's why they were designed, and
that's the word, opportunity.
yeah, exactly. And so I wrote an article not long after I'd done a bunch of research on this, and said opportunity zones may not be the opportunity everybody is expecting.
Sure.
It's kind of a buzzword. Everybody gets excited about it, but
sure.
But I'm probably not the expert you'd want to talk to when you're talking about opportunity zones. But I have found that in several instances when I've looked at different parcels that were located in opportunity zones, there were reasons why it would be difficult to develop.
Sure.
And getting a tax benefit didn't justify building in a market where demand didn't exceed supply. So I have taken the position that I'm going to find the absolute best locations I can find. And in those locations, you generally have to pay close to market rate. It's pretty hard to find one and get a price that's less than market, because everybody knows that that's a good location.
Sure.
But and then if it happens to be in an opportunity zone, great. If it doesn't, I'm fine with that. And I know that my economics work regardless of that factor. And so over the course of the last couple of years, I have yet to find one that's a parcel of land located in an opportunity zone that supports the returns that we try to achieve for our investors. And we try to be in the anywhere from 15 to 20 plus return on investment. So we're looking at relatively high returns now. If you wanted lower returns, you could probably find more properties in those areas. So
Sure. And there's something to be said about, I mean, you're taking a high risk, high reward sort of avenue where, you're acquiring raw and going through the zoning, development, engineering and construction and everything. So obviously the reward has to be high as well. Now, speaking of your in-depth experience, Ken, I want to know your thoughts about the current pandemic and what it entails for, sort of the Main Street, or even perhaps the businesses in general. As, experienced and veteran as you are, Ken, you have gone through several cycles, like 80s, mid 80s, you had 90s, and then obviously we had the 01, though obviously 2008-9 has not been forgotten by anybody. Can you share the pandemic that we are going through? I mean, feels like we are in a much deeper hole at this point. Could you maybe give your thoughts on how you are looking at your outlook?
Well, Sakar, I've been through 7 of these cycles.
Wow.
In my career.
Sure.
The 2 big ones were in the 80s when they had the Resolution Trust Corporation. All of the savings and loans, or most of the savings and loans, went out of business. And, and that was a huge situation.
That was the 85-86 savings loans crisis.
Exactly.
Got it.
And then I've been through the 2008 to 2012, and I learned a few things going through those cycles. But I know there's been this freak out on COVID-19, and we're all wearing face masks. I probably should have worn one today. Sorry, but we're concerned, and I'm in that profile category in my age where I should be concerned about that stuff.
Sure.
And so we're all being careful with that. But I'm noticing this is going through a similar pattern as to what we've been through in other pandemics with SARS and stuff like that.
Sure.
Where we didn't get as restrictive and we didn't shut down the economy.
Mm-hmm.
And so I am watching, even though there's been an escalation of cases,
Mm-hmm.
there's been a decline in the number of deaths that have been occurring. The mortality rates
Sure.
steadily been going down.
Mm-hmm.
So I think we're going to be another 3 or 4, or maybe even the rest of this year, going through this cycle before people gain the confidence that, okay, the market is okay, life is all right, we're going to be okay going and socializing again and putting our children in school. So I think we've still got to work through this. But I honestly feel that when we come out of this, we're going to be close to where we were before. There are some markets, there are some property types that are really going to go through, that's really gone through a transition here. Hotels,
Sure.
entertainment, anything in the hospitality or entertainment business got killed.
Absolutely.
And so I think and I've said this a few times, but I think there's an opportunity maybe to acquire some existing hotels. The cap rates on those things are north of 12%, which is pretty amazing.
Sure.
If you can acquire something at those high cap rates, that means you're getting very good values for your investment dollars. And so we'll see, but I think we can just plan on the next 3, 4, 5, 6 months dealing with what we've got going on. And then I think there's going to be a level of optimism come back in the market that people are going to say, okay, we're confident that we're all right and we're going to move forward. So, and that there may be some that are lengthening that out another year beyond that, but I personally don't see that.
I see. Good. Thank you. Ken, now a couple of last questions. Give us your best advice for newer syndicators starting out. There's a lot of interest to do, like, let's say, multifamily self-storage projects. And as as experienced as you are, can you maybe share some bits of your advice about for newer syndicators who may be listening?
Yeah, I can. First of all, I think if you're a new syndicator and you're trying to put together a group of investors to come into a project, don't get too greedy. Your investors are really the most important thing that you've got.
Sure.
And you want to treat those people with respect, and you want to do your absolute best for them. So you got to be careful not to try and make it. You don't want to get to a point where you feel like, hey, I can retire on this one project. So I think there has to be a really good balance there. And in terms of the fees that are charged and the percentage splits, another thing that I would suggest with new syndicators is don't overpromise.
Sure.
So we've all heard the adage, underpromise and overdeliver.
Absolutely.
Even as a seasoned veteran as I am, that's always a balancing act.
Sure.
And I'm trying to always be careful of that, but still I miss the mark at times. But don't create expectations that 3 years from now you can't live up to.
Sure.
And so you have to be careful on that. And so that means the acquisitions that you do, You got to be very careful on the cap rates that you're willing to accept and your target rates. So I think those are probably the biggest things. And then the other thing, if you're in the syndication business, you're also in the securities business.
Sure.
And you want to make sure that you're doing everything by the book. You want your due diligence done properly and documented. You want to make sure that you hire a good securities attorney. That and by the way, you don't have to overpay those guys. There are some securities attorneys that I when I first got into business were saying, yeah, we'll do this $50,000 number. But you can do these for
much less,
$10,000, much less. You do have to pay a fee.
Sure.
But if you get a good securities attorney, that will go a long way. One of my good buddies is runs the enforcement division for the SEC.
Wow.
In our area.
Sure. Okay.
And so I sat down with him one day and I said, okay, what do I need to do to make sure that I'm a good syndicator and you're not knocking at my door one day saying, you really screwed up and now we're gonna talk about criminal charges. And so he said the number one thing that you can do is create a private placement memorandum, full disclosure, where you just document everything that you're doing and you're disclosing everything and they understand the risks and the potential risks that are associated with the project. And if you do that, then you're going to be protected. And then be careful whether you're doing a 506B or C offering, that you're going by the book.
Awesome.
So
great advice. Thank you, Ken. It is a sheer pleasure. Thank you for coming on. There's so much knowledge. I feel that the time is not enough for one episode. So I definitely would look forward to perhaps having you on another podcast, given your busy schedule. So please share with our listeners how they can find you and learn more about your company.
Oh, sure. Happy to do that. The name's Ken Holman, Holman. Our company is Overland Group, Inc.com. It's Overland Group, but we have several subsidiaries in that: Overland Development, Overland Capital, Overland Construction. So, but you can reach me at the email KHOLMAN @overlandcorp.com. My cell phone number is 801-231-6650. Nobody gives out their cell phone numbers, but I do.
I greatly appreciate it. I'm sure you'll be hearing for more listeners.
Yeah, you're happy to call me. I'm happy to listen to anything you've got to say. If you're a new syndicator and you're looking for some advice, I don't mind sharing. That's what the business is all about. So
thank you for being so grateful and so gracious to come on, Ken, and share your advice and experience. It is an honor, and I will be definitely looking forward for another episode with you. So with another great advice from you for sure.
Thanks for the opportunity. And hey, the next deal we do, we'd love to have you as a partner. So
absolutely, we are on board for sure. Thank you for coming on.
Thank you. Good to talk to you.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.